All right, for Module 7, our first part here in Chapter 11, we're going to look at the stockholders' equity in much more detail, where the company issues stock to raise money as a corporation, and then instead of maybe issuing bonds or notes. And then, so we've got to know what kind of stocks there are that the company can issue, and then how do you journalize that? And then what happens if the company buys back their own stock? Because that happens as well. And then one of the latter things we're going to look at is when companies pay dividends, how do they know how much to pay? And then how do we keep track of that as well? So the first thing I wanted to just briefly look at is the two different types of stock that companies can offer. They offer either common stock, which is by default, that is the one that if they only have one, they can only do one, that's okay. That is the one they're going to use. And this is the basic ownership. And you can see, you can read through here what it entails, just real basic. I don't go into a lot of detail, just to give you an overview. And then the preferred stock, this doesn't mean that it's better, it's just the name that's given to it. Preferred stock has some ups, has some good sides to it, and then depending on how it's labeled and how it's issued, there are some downsides to preferred stock as well, so it's not always just the best one. With preferred stocks, you're going to see when we get into some problems, they're listed. There's going to be a percent sign with a number, like 20% of par of whatever the par value is. That percent is going to be how much of dividends the preferred stockholders get, because usually preferred stockholders get a set amount of dividends, and then common stockholders get whatever's left. And so preferred stockholders usually get the first dibs. They get a first set amount, but then a lot of times that's all they get. Common stockholders get to enjoy the rest of it, which could be very little or could be a lot. That's why the common stockholders have the most risk, but also the most reward. Preferred stockholders have less risk because they generally will get a certain amount, but then perhaps they won't get more than that at the end. It all depends on how the stock is labeled, though. One thing to note before we keep going, though, is no, dividends are never required. Companies do not have to issue dividends. So just because preferred stock gets first dibs, that's only when dividends are actually issued. Companies do not have to issue dividends. It's not like when companies issue bonds, they have to pay that interest, whatever's on there, however it's often stated. Or with a note, they have to pay back that note. With stocks, that's not the case. They do not have to pay dividends. And the percentage sign in front of the par simply says, in this case, if it was 20%, $100 par, they would get, for every stock that they own, $20 of dividend if dividends are given. So 20% of 100 is 20. They would get $20 of dividends for one share that they own. Now, when stock is issued, it's going to be in one of these 5 areas where it's going to be landed. So when a company first starts out as a corporation, they're going to set a certain number of authorized stock. That's how many they are allowed to sell. They can't adjust that without doing some major work. That's going to be how much they are allowed to issue. And then once the stock is actually been issued to the public, it stays issued. And once it stays in the public, and once it's continually in the public's hands, it's called outstanding stock. Because a stock can be issued, but then bought back by the company, and that's called treasury stock. It's still listed as issued because it has been issued one time, but it's been bought back, and the company still has it in their hands for the time being. They can resell it at any point, and then it becomes outstanding again. Outstanding simply means it's out in the public hands, and dividends can be paid to it. And then retired stock, if the company decides they're never going to reissue that stock, it'll basically become unauthorized at that point. The number goes down, and that stock will never be issued again. All right, so let's see how stock is, how it's journalized most of the time. When you issue stock, you're typically going to see a par value. Par value, also known as the stated value, those are synonymous terms. The book will try to throw in both terms in some of the problems. Just make sure you use the correct one. It'll say common stock at stated value or common stock at par value. Pick the one that the problem is saying. Both of them, common and preferred, will have par value. And that's simply what you list. So let's, before we do that, let's come over here. When you see, I've got an expanded, and you have a copy of this, and you'll want to open this up. This is for part of the problem that we'll get to in a little while. And I've already got the opening numbers here. But as you can see, I've expanded the owner's equity section of the T account page that we normally use. We now have common stock and preferred stock. And then down below, we're going to talk about these, the additional paid in capital for both. You remember retained earnings, that's still there. And then the other two that we're going to look at is treasury stock and additional paid in capital for treasury. Remember treasury, that's our contra account, because treasury is when you repurchase your own stock. So it's going backwards, it's going back into your business instead of being issued the stock. This common stock and preferred, these are the par value. When you, these are always listed at par value. So that's what this is. And then anything else over and beyond the par value that the stock sells for goes down here in additional paid in capital. So we're going to see that now, how that looks, because I know that's kind of confusing right now. All right, so when we look at this example number 1, and we issue 40 shares, and they are designated $5 par common stock, but the stock is currently worth 20 bucks a share. How we're going to journalize that is we're the company giving ownership. So people are paying us to be part owners of our business. And so they're giving us, or we're giving them 40 shares, and they're giving us 20 bucks a share. So when you take 40 times 20, the company is getting $800. And then how we record that stock is we say, okay, in the common stock over here, we would have put 200, because the 200 comes from the number of shares times just the par value. And then whatever's left to make your debits equal your credits, that's what goes into the additional paid in capital. So these two accounts, you can see their numbers are real close. They go together. I just made up these numbers. You could have done 300 and 301 over here, and then 310 and 311. That's fine. I put these two together just to show that they are kind of a pair when you do journal entries. And then the preferred stock looks the same way. Let's say we issue 10 shares of 40% $20 par preferred stock for 50 bucks each. This part is just extra information for right now. This is simply going to tell us how much dividends are paid. It's saying that whatever 40% of 20 is, so if you do the math, that's $8. That's how much dividends each preferred shareholder is going to get, $8. And we got 10 shares, so as long as we give out at least $80, they're going to get the first 80. But how we journalize this, we take the 10 shares and how much they're valued at, and what the investors are paying us. They're paying us the $500, 50 times 10. And then the preferred stock, just like common, is listed at its par value. So 20 times 10 shares, 200. And then the additional paid in capital is whatever's left to get the debits to equal the credits. And then we would have put these over here in their two accounts, the 200 and the 300. Okay, now when a company repurchases their own stock, again, it's called treasury stock, and it's a contra. You're buying back your own company. So what you do is, instead of putting it over here, you would normally, that would probably be your thought process. If I'm buying back stock that I already sold, well, then I would just come over here and debit the common stock. That's not how it's done, and there are reasons why. We'll get into that when we resell the stock in just a minute. But we put it over here into its own T account. So the treasury stock, it's contra. That's why I have it in red. And it's going to have everything over here when we purchase it. And then if I resell the treasury, I'm going to then credit it, just like I'm putting money back into my owner's equity. All right, so treasury stock, it reduces your owner's equity. If you resell your treasury stock, when you resell treasury stock, think of it like selling inventory. Because when you resell your treasury stock, you're going to get rid of the treasury at what you bought it at. Just like when you buy inventory and then you get rid of it with cost of goods sold, you get rid of it, the inventory, at what you purchased, and then the rest of it is your sale price, how much you made on top of that. This is the same. You're going to resell your treasury at whatever you bought it at, and then anything above that is called additional paid-in capital. And I like to think of this as a gain account. Now, it's not a gain, but it's similar to a gain. You can't have a gain in yourself. So if I had bought this stock for $5,000 and then I resold it for $6,000, I don't want to put $6,000 over here because that's going to have me a negative balance. So I'm going to put the $5,000 over here to get rid of the treasury, and then put the extra $1,000 over here. That's kind of like a gain. I bought it for $5,000, but I resold it for $6,000. That's pretty good. But if you ever resell it for below the purchase price, what you have to do, it'll say I bought it for $5,000 and I resold it for $4,000. I have to get rid of it at the $5,000 because I don't want to show $4,000 because then it's going to look like I still have $1,000, but I don't. I got rid of it all. So I have to get rid of the entire treasury, and then I have to come over here as a negative and get rid of any gain that I have accumulated. And if I don't have any gain that I've accumulated or I run out, the rest of it is going to go to as a negative to retained earnings. So that's how that's going to work. All right. We're going to take a look at these examples, starting with number 3. Okay, so when we've already purchased that common stock up above, we purchased the 40 shares in example 1. Now we're buying back 15 shares of that common stock, and we're buying it back at $25 a piece. Remember, I had originally sold it for 20 bucks a piece at $5 par. So I'm reselling it, and I'm actually getting a little bit of extra money. We don't count that extra money right away. So we only count it as a gain. Remember, it's not really a gain. When I buy the treasury, then resell the treasury. When you initially buy treasury stock, you just put it in your treasury stock T account at the price you bought it. Just like if you bought merchandise. You put it in your merchandise as a holding point until you sell it. So I'm putting that treasury stock at 15 times 25. I would put it down here at the 375 as a debit. It's going to increase that treasury, but for any other owner's equity, a debit, what it does is it's a contra, so it reduces your owner's equity. And then if I'm buying back the stock, I had to pay money out to get that, to buy it back. So I had to give my investors $375. Now, I originally, just a second ago, I had said it's like we gain money. I misspoke there. We sold it for 20, but we're buying it back for 25. So we're actually buying it back for more than what they paid for it. They're getting the gain. But we don't count it as a loss, or we don't count it as a gain when we buy it. Either way, we only count it as and again, it's not a gain or loss, but I like to, it helps us to think about it. We're only going to count it as a gain or a loss if we resell the treasury stock, and then we compare it to what we've originally bought it at. Note here, there's no par value. I'm simply just putting that treasury into a temporary holding account. It's at $25, and then when I resell it, then I'm going to get rid of it at 25 as well. So that's what we're doing here in example 4. We bought back 15 shares. I'm going to resell 5 of those 15 now, sometime later. And I'm reselling them for a little bit even more. I'm reselling them for 27. I bought them for 25. So when I resell them, the investors are giving me cash. They're giving me cash for 27 times 5. And then I'm getting rid of the treasury at what I bought it for, the 25. So the 25 times the 5 shares is what I'm getting rid of. So I'm getting rid of $125 of treasury. The rest is that gain that I made. I made $2 a share and I sold 5 shares. So it's 10 bucks. So I would have 10 bucks over here in my additional paid in capital treasury, which is like our gain account. Now, what happens then when I turn around and if I sell the treasury for less than what I bought it for? If I sell it for less than the 25, say I resell it for $21 a share, well, then what happens is I got to say, okay, I'm getting cash from my investors. I'm reselling 8 shares. They're giving me $21 each. So if you do the math, that's $168. Now I'm going to leave this one blank for just a second because I need to come down here and see what I'm going to credit. I'm going to credit my treasury stock for not the 21, but the $25 that I bought it for, just like up here. So 25 times the 8 shares is 200. So I'm going to need to show that, oh, this time I kind of have a loss. How we calculate that is we would first put in whatever we have in our gain account and then take as much of that as we can up to the amount that we have. If I only have $10 in there from my one transaction, then that's all the more I can take back out. If I had 100, then I could have done I could have made this as one debit for $32 and still had some gain left over from the previous sales. But I don't have enough. I don't have enough to cover my entire loss. I only have 10. That only takes me to 178 in debits compared to 200 in credit. So the rest of the loss comes out of retained earnings. We don't want to ever do that if we don't have to. We don't like to ever debit retained earnings because that's taking away part of the investment in the business. But in this case, since we resold the treasury for less than what it was worth and less than any gains that I had left, that's what we had to do. Okay, dividends. When the company decides they're going to pay their stockholders dividends, usually there's three different dates. There'll be the date that they declare the dividend and say, yes, we're going to pay dividends. And it's going to say then, we're going to pay dividends to everybody who owns stock on this specific date, whatever that date would be. So just to put in some numbers here, the company, the board says we're going to pay dividends. We decided at our meeting on July 1, we're going to pay dividends to whoever owns stock as of July 15th. And then we're actually going to write the checks because it takes a little bit of time to figure out everybody who's going to get in. And we're going to send out those checks August 5th, those dividend payments. So dividends are simply a way, so if you're an owner of a business, if you are just an owner of a small little business, then you would expect that any profits you get to reap in that. Same here. Dividends are what they're designed is to provide a profit distribution to all of the owners. And so with a corporation, there could be lots and lots of owners. So you all get to split a little bit of the profit. Now, companies can decide that they don't want to pay out all their profits. They want to reinvest into the company. And so that's where boards have to make the decision. Do we want to pay out dividends? Yes or no? And then if we do we want to pay out everything that we made and have nothing in reserve? Or do we want to pay out just a little bit or a lot? They're going to have to make that decision. Stock dividends, if a company is kind of low on cash, they can still give out dividends. It's just not cash. It's just giving your owners more stock. So, and that's good if the owners decide to sell. then when they sell their stock, they're going to get money that way through the selling of the new stock that they have. Usually when there's a stock dividend, the assets of the company don't change. Your value in the company stays the same as well. It's just you have more shares, and the more shares you have, usually you can get more money out of it later on. So I just gave a little example here. We declare $1,000 stock dividend, and the common stock is $1 par, and it's worth $3 a piece. So what I would do is how I would journalize this. I could debit my dividend, or the book is going to have you just debit retained earnings, because if you remember, dividends, they get closed at the end of the year. And so instead of taking that extra step and closing it out later, they're just going to say debit retained earnings, which is okay. I like to go ahead and debit the dividend account if it was me, because otherwise why even have it? So you debit either one of these, and you debit it for the total value that your owners are going to get. They're going to get $3 a share, and there's 1,000 shares. They're $1,000 stock, 1,000 share stock dividend, and the par is $1 par, so common stock at par is 1,000 shares at $1, so 1,000, and then whatever's left, additional paid in capital, is how you get your credit there. So that one's, as you can see, there's no assets involved. It's just a rearranging of all of owner's equity accounts. You're taking money out of your retained earnings, out of your profits, and providing it as ownership to to your shareholders. One of the last things we're going to look at now is the difference between a stock dividend and a stock split. With a stock split, there is no journal entry. Nothing officially happens on your books. The only thing that happens is par is cut in half if it's a 2-for-1 stock split, and the value, so your par is cut in half, and the value of the stock is usually cut in half, but the number of shares that you own doubles. So this is my little example here. We originally have 100 $10 par stock, and there's a 2-for-1 stock split. So if we had 100 shares, we now have 200 shares. It's a 2-for-1. For every 1 share you have, you now have 2. So instead of 100, I have 200. But the value of those shares, par value, isn't 10 anymore, it's only 5. So when you combine these, if you said I had 100 $10 par stock, that's $1,000 of ownership. But then you think, after the stock split, I should have more, right? Yeah, the answer is no. You have the exact same. You have now 200 shares, but they're only worth $5 each. So that's still $1,000. And you think, well, why would the company ever do that? Well, as you can see, what it does is it lowers the price of the stock. It allows more investors to come in if they want to try to divvy up the ownership a little bit or bring in more demand. So now if the stock was kind of stuck at 10 and nobody really wanted to pay any more than that, they can bring it down to 5. Now people are wanting to pay 5. They're okay with that. So the stock will go up to 6 and 7. So now you have 2 shares that instead of one being worth 10, you have 2 that may be worth on the market $7 a piece. And so now you can, instead of selling your 1 for 10, you could sell 2 for 7 each, and now you got 14. So that's why stock splits can be good for the owners. And that's what I'm saying here. Studies show that a stock split, those shares that split outperform those that don't by keeping the price lower. And as you can see, here's a little example of some of what happens on a stock split. There's no journal entry. So notice your common stock, your APIC, and your retained earnings and your total all stay the same. Nothing changes except just the number of shares and the par value. That's it. That's the only thing that changes. All right, our last two little tiny things here. Earnings per share, that's something a lot of investors will want to look at to see how the company's doing and if they want to buy their stock. Earnings per share basically is best case scenario. It says if the company gave out all of their earnings, they usually don't. They don't give out all of it. They like to keep some to rebuild the company, keep some for a rainy day. But if they did give out everything, how much would I as a common stockholder get? That's what this earnings per share talks about. And it's the formula simply is, okay, whatever net income is, how much money did I make? And then remember, preferred stockholders get dividends first. So we have to take their money out. Once I take their money out, whatever's left, then I share it amongst everybody that has shares of common stock outstanding. Notice it's the outstanding. It's how much are still in the public hands. Not that I've bought back. I don't pay dividends to myself as the company. It's just whatever's in the company's hands. And finally, if when a question and we look at them, that'll say, what's the book value per share? So, we talk about book value and we talk about the value of equipment on our books. This is kind of the same thing. Book value per share, we're just going to look at total stockholders' equity and then divide that by the number of common stock outstanding, just like this. So the only thing that's different here is our numerator to figure out what's the value, the book value of each common share. Okay, to help make this, I'm gonna kind of do a little practice example now. So this is where you'd want to go ahead, if you haven't already, get out this number 50. I've already, the first tab here simply shows, and we're going to need to go back to this, but it says what kind of stock we have, what the value is out here, and I have these in the T account. So if you look at the preferred T account, preferred 5,000, common at 1,000, and that's what these are, the values. We're also going to need to know this stuff over here. It's telling us what the par value is. We're going to need to know that. We're going to need to know how many shares are actually outstanding. We're going to need to know if it pays dividends, that it's 20% of the par. Non-cumulative simply means that if no dividends or not enough dividends were given in a certain year, so let's say there was just one share. So 20% of 50 is 10. So 10 bucks. If only $9 were paid that year, that one shareholder would be missing out on $1. Common would get nothing. But if it's non-cumulative, that means that they don't get that back dividend from the prior year. They just start over the next year like they got it or not. It didn't matter. Common never gets stock and back in arrears, what's called in arrears. If it's called cumulative, that means that they do get those back dividends. So if they only got $9 out of the 10 this year, then the next year they get that extra dollar plus the 10 for the new year. And then common stock has to sit out even more, and they get even less because preferred stockholders are getting back years if it's called cumulative. Then we got our additional paid in capital for whatever we sold things over par. I've got the retained earnings here. And then finally, I show that we have some treasury stock that we've already bought back at some time in the past. And we currently have 200 shares and we bought them back at $25 each. And then the last thing, to make the equation balance out, I just put in a few numbers so that our assets equals liabilities and owner's equity. So that's what you'll see over here in our assets and liabilities. We have some cash, we have equipment down at the bottom, we have an account payable, and then I've added up the equation. And both sides right now equal 15,000. You can see the owner's equity has a lot more things added up. And then this one is subtracted because it's contra. So what we're going to do now is simply build on this to see how these journal entries work. All right, So what I'm going to do is I'm just going to post the, I'm going to do the journal right here, and then we're going to put them over here into the T accounts so we can see the T accounts grow. And then when we're all done, what we're going to do is come over here and put new numbers out to the side of what, so this is last year's numbers, beginning of this year, and we'll put over here the end of this year's numbers. All right, so the company decides to issue 300 more shares of preferred stock. The stock sells for 75 bucks each. Notice I don't give you all the information here. I want you to be able to come back to here and figure out that, oh, it's $50 par, and we're selling it for 75. So when we do the journal entry, we're getting cash. You want to have your calculator ready. We're selling, it says the company decides to issue 300 shares, and we're going to get $75 a piece. So that's $22,500. And we're going to credit our preferred stock. Remember the preferred stock, it had $50 par right here. So that's what we're simply going to take 300 shares times 50 par at 15,000 and credit my additional paid in capital for whatever's left. And if you do the math there, that's 7,500. So I come over to put in the on January 1, I put in the 22.5, and then for preferred stock on January 1, I had 15,000 and 7,500 added in for the additional paid in capital. All right, we reissued the 200 shares that are in treasury stock. So I come down here and I look at treasury. Yep, there's 200 shares. We bought them for 25. I'm selling them for 30. So that means I'm actually making some money. So when I come down here now to do my journal entry, I'm reissuing those shares that I currently have bought back. I'm selling them for 200 shares at 30 bucks a piece, so $6,000. I'm getting rid of my treasury stock, and I'm getting rid of them at $25 a piece, all of them, all 200. So I know you don't even have to do it on your calculator. You know it's 5,000, has to be, because that's what the value is on my books. And to get the debits to equal the credits, because I actually sold them for more, I'm going to put it here as my quote unquote gain account for $1,000. So now if I ever sell treasury stock for less, I have a little bit to, of a leeway. I have $1,000 I can play with and still not have to affect my retained earnings, which I don't ever really want to. So I'm going to come over here to my cash on February 1. Put in 6,000. Come down to my treasury stock on February 1. Get rid of it's a credit, so get rid of my 5. I'm at 0. And then put into my new gain account $1,000. I sold my treasury stock for more than what I purchased it for. So we now issue 1,000 more common shares from the 3,000 that are authorized, and they sold for 30 bucks a share. So if I look back and I'm telling you of the 3,000 that are authorized, if I go back to my common stock, I have 3,000 shares. I've only issued 1,000. So I can still issue more. I still have 2,000 left that I've never issued. So out of those 2,000, I'm issuing 1,000 of them right now. So I'm going to come down here. I'm going to debit my cash for the 1,000 times 30. So that's 30,000. 30,000. And then remember, common stock is always listed at par, just like preferred stock. And if I go back to my sheet, I can see that the par value is just $1. So $1 times 1,000 shares is simply 1,000. Then all the rest goes to my additional paid-in capital, 29,000. So now my debits still equal my credits. Right, let's update our T accounts. We're at 15. We brought in 30,000. Then on 215, another 1,000 of common stock at par. Then on 215, the rest was additional paid-in capital that I sold it over the par value. Okay, now we're going to look at how a dividend works. The board declares a $15,000 cash dividend. So we always got to see what kind of dividend it is, stock or cash. Not payable, and it's payable till the April 1st. And I ask us here who gets what. You typically won't do this on the book exercises, but I think it's a good exercise to do at this point, because the book won't necessarily have you do it when you're doing the journal entries. They'll have you do it on a separate problem, and they'll say, okay, well, who does get what? So we're just going to do it all at once here. So when we issue a dividend, we can debit dividend, or you can simply just get rid of the temporary account, the dividend, and the book is going to have you just debit retained earnings. Either one will work. So we're going to debit the 15,000 of dividend. And then since we're not paying it yet, we're going to call it a dividend payable. But since I want us to break it down who gets what, we're going to call it a dividend payable to my common stockholders and a dividend payable to my preferred stockholders. Now, when we decide, well, how do I know who gets what? Remember, preferred stockholders always get first dibs. And they get first dibs based on this. Whatever this basically says right here. And this says that they get 20% of their par as a dividend, and it's non-cumulative. So it doesn't matter if they got all of their dividends in prior years or not. It starts over every year. So 20% of 50, that's $10. So they get $10 of stock or of dividends per share. Now, I haven't issued any new shares of preferred. That's the first thing I'd always want to look. Am I still at, oh, sorry, I forgot about that. Good thing I looked. I have issued new shares. So I go back up here and let's see how many I issued. 300. So I had 100 issued and outstanding. Now I've issued another 300. So now I'm at 400 issued and outstanding. So out of the 400, I have 400 shares, and each of them get $10 a share. So again, let's see how we did that. 100 shares, 100 were already out in my books, 100 shares. On January 1, it says I've issued 300 more shares. So now there's 400 shares that I have to pay dividends to, and each shareholder gets 20% of $50. So that comes out to be $10. So 400 times $10 a share, these guys get 4,000. Common stockholders get whatever's left. It's 11,000. Might think, oh, well, the common stockholders did a lot better. Did they though? Because these guys got $10 a share because they don't have to split them up amongst everybody. The common stockholders, there's a lot more shares. We have 1,000 plus we just issued another 1,000. So there's 2,000 shares that I have to divvy up all of this money. So you just do the simple math. 11,000 divided by the 2,000 shares that are outstanding, they only get $5.50 a share. So it looks like they're getting more, but there's a lot more people to distribute it amongst. So preferred got $10 a share. They did better. Common stockholders got more money, but per share wise, they didn't do as well. Now, April 1st is going to be a real easy journal entry. We're just simply paying off these that we owe. So dividends payable would be debited. Common stock, 11,000. Dividends payable for preferred stock for the 4,000. And simply cash for the full 15,000. So that's a real easy journal entry on April the 1st. All right, so now we're going to see journalizing treasury stock, bringing it into the company again, because remember we are at 0 currently, but we decided to buy back 700 shares. Cost of each share is $40. So I'm going to debit my treasury stock. Come over 700 times 40, 28,000. Pay cash for 28,000. Now, one thing I forgot to do, let's go ahead and fill these in into our T accounts. I'm just going to put it right into retained earnings, which in this case isn't too good because we only started with $5,000. Hopefully we made money throughout the year. We're going to see that. So right now we're in the negative in retained earnings. That's not too good. We had dividends payable. I'm not going to make one for both of them. I'm just going to combine them into one. So on 3/1, I had 15,000 in dividends payable, and then on April 1, I paid that off, so it equaled each other out. And then on 4/1, I paid 15,000. So all I've done is just updated my T accounts to show all of this. Okay, we bought back some treasury stock, so let's put that in on July 1. So on 7/1, I have a debit of 28,000. And then I have a credit over here of 28,000 being paid to buy the treasury. Now it says we go ahead on August 1, we resell 300 of those shares at $42 a piece. So we're actually making money. That's nice. Debit our cash. Just do the 42 times 300. That's what we're bringing in, 12,600. We're going to get rid of the treasury stock. We're going to get rid of it at what we bought it for, the 40. So that's 12,000. And the rest goes into my gain account that we don't really call a gain. The $600, that's how much I made on that transaction. So let's update my books on August 1. 12,600 brought in. Come down to my treasury. On August 1, I got rid of 12,000. And I made a little bit on August 1. I made an extra $600. I'm going to need to add another line. Next entry, so I'm just going to do it now. When we get down here to September 15th, I'm reselling another 300 shares. Remember, I bought back 700. I've resold 300. I'm reselling another 300, so not quite all of it. This time, though, I'm only reselling it for 35 when I bought it at 40, so that's not good. That means I'm going to be losing some money. So I'm going to debit my cash. 35 times 300, I'm bringing in 10,500. Remember, we're going to need to see if how much we need to use if we have enough. So I'm going to leave that blank for a second. I know a debit's going to go there. We're just going to see do we need 2 debits or just will 1 be okay? My treasury stock, I need to get rid of 300 shares at what I bought it for again, which was 40 bucks. So that's going to be the exact same as we did on August 1. We're getting rid of 300. We're getting rid of another 300. So that's 12,000 again. The difference here, 1,500. If I look in my temporary gain account, I have just enough to cover that. So I don't have to go to retained earnings and take a little bit more of a loss. I can put here 1,500 and still not go below 0. We don't want this account to go below 0. So I can go ahead and fill this one in. On 9/15, I'm going to have additional paid in capital for treasury. I have the $1,500 to cover it. That's how you kind of want to think of it. So on 9-15, I put another 12,000 here. Let's get these down to size. There we go. Sorry about that. All right, so I still have $100 in my additional paid in capital, should I need it. Now we're getting ready for the final piece, the final couple items here. We declare, now this is going to be a different type of dividend. We declare and issue a 10% stock dividend, and it's only going to my common stockholders. Preferred have already been paid. The market share is $40 per share. So whenever we issue a stock dividend and it's less than 25%, so this one's only 10%. If it's 25% or it's less than 25%, we value it at the market share. If it's over 25%, then you value it at the par value of that stock. So this one's less than 25. We're going to value the dividend at the 40 bucks a piece. So it's going to be, to start out, it's going to be similar to what we just did above when we had our dividend, where the book is going to call it retained earnings. We're going to just debit retained earnings. You can debit as dividend and it'd be perfectly fine. So how we figure up now what the dividend is worth? Well, the first thing we have to do is figure out how much in stocks do I have outstanding? Because of that, however many shares I have outstanding, that's how many, 10% of that is how many new ones I'm giving out. So if I go up to my common stock, I have, because these are $1 par, so it makes it real easy to figure out how many shares. I have 2,000 shares, but I still have 100 shares down here from the treasury, because remember I bought back 700 and then I reissued 300 and then another 300, so there's still 100. So I'm going to make a little note off to the side that I have 1,900 shares that I'm going to now issue 10%. So 10% of 1,900 is 190 shares. That's how many new shares I'm giving out. And the shares are valued at $40 a piece. So if I take 190 times 40, that's how I get the value of the dividend. So $7,600. Now, since it's a stock that I'm giving out, I'm going to show that it's stock that I'm giving out, not cash. I'm giving out 190 shares. Remember, the par value is only $1. So that makes it real easy to figure out what my common stock is going to be credited for. And then everything else, the additional paid in capital, goes here. So that would be $7,410. All right, so let's put these in. The only thing I didn't do, I don't think I put this guy in yet. So let's put in that 10.5 of cash from September 15th. Now we're ready to do the December 29th. We had $76 going into the retained earnings as a negative. Common stock went up 190, and the additional paid in capital went up 74.10. Now, the final thing I need to do is the company had 30,000 of net income this year, and all revenues were received as cash and all expenses were paid as cash. So basically what this is telling me is I have 30,000 in my income summary. So let's just simply close out my income summary. Let's see here how we want to do that. Okay, so the first thing we want to do is it's saying all revenues were received and all expenses were paid with cash. So I basically would have had this one big entry. I would have had something that comes out to be $30,000. I would have had cash coming in of let's say 100 grand, making something up, and revenue of 100. And then to balance that out, I would have said, let's just say an expense. It doesn't matter which one, or there's lots of expenses we probably had. But those were 70 grand because my revenue minus my expenses needs to be what my net income is. So I paid cash of 70,000. When I combine these, that's where the net income comes from. So now what I'm ready to do is this is what happened throughout the year. Now I'm ready to do the closing. I need to debit my revenue for 100,000. I need to credit my expenses for 70 to get rid of them. And then I need to credit my retained earnings for the difference. Or you could do income summary and then cancel out and do retained earnings. I'm just going to skip that step and just go right to retained earnings. So let's update my books here with the new numbers. I had 100,000 throughout the year. And then I closed it out, so it just went away. So that's back to zero. I had, let's say, an expense here of 70 grand, but then I closed it out with my closing entries. So this basically did this entry, and then it came down and did this one. And then I did this entry and came down and did this one. Now let's finish. Let's do the two cashes over here. I had 100 grand. Then I had 70. Okay. So now I've taken care of this whole thing. I've taken care of this. The only one I have left to do is my retained earnings. Retained earnings went up 30 grand on 12/31 from the closing. All you got to do when you have a closing amount. You still got to put in the cash because otherwise your balances aren't going to work. Okay. So now what we can do is to see if, let's see if our equation still balances and we can update our owner's equity section. So we're going to go through and total everything up. So I would go ahead and do this along with me. We have our balance down here. I'll just put it down here. These two totaled up. We have our balance. Additional paid in capital. And we have our balance for additional paid in capital for preferred. Retained earnings. We have these two added up because these are on the positive side, minus our two debits. So our retained earnings currently did go up because of the money we made throughout the year. Treasury stock. The balance is going to be on the debit side because it's a contra. So we're gonna add up our two debits and then subtract out our three credits, and we should still have a $4,000 balance. Yep, 4,000 comes from the difference of this. And then finally, we had a balance down here. Remember, it's just going to be $100. That's the 1,600 minus the 1,500 that we gave up on our treasury stock on that loss. So if I update and I add up all of my new totals, we're going to see what we get when we add up all of our credits. And this should not be a negative. We're going to have to fix that one. Put it in for right now. The only one we do want is a negative, so we're going to subtract is this guy because it's contra. Let me see what went on here. I put in a negative sign here. So now that works. 9,500, that's what that should be. Okay, oh, I didn't add up everything for whatever reason. All right, let's try this again real quick. We got the 2190 plus the 20,000 plus this guy plus this guy plus the retained earnings plus the additional paid in capital for treasury minus the actual treasury. 80,600. My liabilities, they didn't change. Still got the $3,000. The only thing that changed over here was my cash. We had a big change. Let's see what it was. We need to add up all of my debits, subtract out all of my credits. 78.6. So is just put in our new total plus my equipment that didn't change. Remember my revenue and expenses, they canceled each other out. They went into retained earnings. So there's 0 and 0 here. And if I add up, it does look like everything worked out. If I add these two together, 80,600 plus 3,000, that's 83.6. And that is what my assets are. Now the final thing, when it in a book problem, when it says go ahead and update your stockholders' equity, it's basically we're just putting in these new numbers. So I would have my preferred stock is now at 20,000. My common stock is now at 21.9. So I would put preferred at the 20,000, my common stock at 21.9, and then work my way down. And when I'm all said and done, my total stockholders' equity better be that 80,300 or 80,600 that I got from my T accounts. That's how you'll know if you've got the stockholders' equity done correct. All right, it's a lot of new stuff. I hope you stayed with us through that whole time. We're going to transition into part 2 where we actually look at some of the Connect exercises.